There is one problem almost every NVIDIA employee has, and almost no one explained it clearly. Your NVIDIA RSUs vest, taxes get withheld, then April comes, and you still owe more. That gap isn't a mistake, and it's not NVIDIA's fault. It's simple math. You are withheld at a flat rate, but your real tax rate is higher. Almost nobody explains that clearly. So today we will. Welcome back to the STR Loophole Show. I'm Arda Birkan, founder of STR Loophole. If this is your first time here, we cover real estate investing and tax strategies for high-income professionals. Hit subscribe so you don't miss the next one. Let's get into it. I'm here with Matt Bontrager, CPA and the founder of True Books. Matt, welcome.
Arda, thank you for having me, man. This is a good topic.
In this episode, we cover three important things. NVIDIA RSU mechanics, why that withholding gap exists, and then the legal tax strategy that offsets it, not the version people half understood online, just to be clear, and how it works if you are sitting on concentrated NVIDIA position. Let's get into it. Matt, you are a tax strategist who actually gets into the weeds on this stuff. You also work with high-income W-2 earners with large RSUs. Before we get into the strategy, let's fix the thing that confuses everyone first. Can you explain what actually happens tax-wise the moment my RSUs vest?
Let's talk about the mechanics of an RSU first. So what most people don't understand is that this becomes a taxable event at the vesting stage of when you get an RSU, not necessarily when you are granted them. And what another thing people forget is that the fair market value of the shares on the vest date is taxed to you as ordinary income in your W-2. And so we'll actually dive into that later because as a tax practice that helps clients with this space, we see where people go wrong trying to do their own taxes, whatever it may be. Right. So we'll talk through that so people with RSUs can know what to look for. And again, when you vest in these RSUs, they are subject to federal and state income tax, Social Security, Medicare. And so nothing is unique necessarily about NVIDIA versus a SpaceX versus a HubSpot, whatever it may be at whatever organization that these people are at. It is how every public company's RSU schedule will work. You are going to be taxed the same. The next piece that I want to talk about is what you hit on the head is the gap, right? And that is because withholding for these is a statutory flat rate, not an estimate of what your tax bill is essentially going to be. And so for context here, I have some notes. 22% is withheld at a flat rate on the first $1 million. And again, could these percentages change depending on who maybe the payroll provider is, right, or the administrator of the RSUs? But typically 22 points on the first $1 million is what is withheld there. And then 37% flat rate on $1 million plus. And so as you notice here, this could be less than what your effective tax rate is ultimately on the income that you've made throughout the year. Whatever your spouse makes as your total household income, this could be a lower rate than what your effective tax rate is, which is the important factor here because that leaves people in this stage to where they feel that they need to liquidate their RSUs in order to satisfy their tax bill. So it puts them in this sort of cyclical confusion of what is the finite number that they should liquidate to satisfy their tax bill, because we've also seen people liquidate to satisfy their tax bill, but that liquidation has also triggered another taxable event as well. So making sure that they understand if there is a gap, they identify what it is and how to navigate their way through it. And again, this is not just specific to an NVIDIA company. This is anybody where you're going to get RSUs here.
A lot of employees end up heavily concentrated in NVIDIA stock. And I hear about cost basis errors on tax returns constantly. So can you explain exactly what's going on there?
Yeah, so I think first the concentration component comes from these people aren't necessarily business owners, but it is a heavy form of how they are compensated. And so if they don't end up liquidating their positions outside of the RSUs that they have, most of their worth and net worth will be built in this RSU stock. So at some point, maybe more of a financial advisory question or topic is they should start to, unless they truly believe in the company and they want to leave their net worth within there, understand what it's like to start liquidating some of their positions out of the RSUs so that they can start to spread their wealth amongst other areas and diversify the risk, basically, is what it is. You hit on a really good topic, which is the understatement or overstatement or mishandling of the cost basis of RSUs. And we have a client going through this right now. So this is a very hot topic for me. What has happened in this specific situation and can happen a lot is, here are the facts of this sort of situation. Client of ours receives RSUs as a heavy form of their compensation. They're a high-level executive at a company like this, like NVIDIA, where they're given RSUs. What this client didn't understand is, one, they self-prepared their taxes. So this is just a natural occurrence of what we'll see because they don't understand what they need to have in order to do their own tax return. It's not bad to do your own tax return, but now hopefully someone here will take this and understand what they need to do their tax return. RSUs are taxed to the recipient, not only obviously when they vest, but it is built into their W-2 income. So I've held W-2 positions before. You receive the W-2, there's a taxable wages, and then there's your federal withholdings and a couple other boxes with red, obviously, information. The RSU value that you have vested at is included most of the time, should be, in the wages line item or box of your W-2. So in this case, if I have an $800,000 W-2, maybe my salary is $500,000, but I have $300,000 worth of RSUs that are also vesting. My W-2 should reflect $800,000 in income because I'm being taxed on the ordinary value of those RSUs when they vest. The problem that this client ran into is, one, she input the W-2, and I think it was TurboTax. TurboTax is a fine software. I make the joke as a CPA, I even used TurboTax before I started doing my own taxes. She input the W-2 into TurboTax, which is now including her salary and the RSUs. And she also took the brokerage statement that she has and input that into the software as well. This is where it goes wrong. She didn't need to input the brokerage statement because those amounts are already included in the W-2. So if you think about it, this is error number one. She's including the brokerage statement and the W-2, which is your double counting at that point. The next piece is, which is really the part that hurts the taxpayer, whoever this happens to, is the brokerage statement a lot of the times will reflect a $0 cost basis at the brokerage level, meaning Fidelity, let's say, is going to show what the proceed amount is, which is the amount that they received, obviously, at that time when they got those shares. But the cost basis is reflecting zero. So not only, let's think about the numbers. This client input a W-2 of $800,000, and let's say $300,000 was the RSUs. They also gave it the brokerage statement, which is adding another $300,000 to this as well, because now we're double counting the stock portion. But having a $0 cost basis is, again, a second layer of complexity, which is hurting her, because now not only did she double the income, it looks like she received these and didn't pay any tax for them, when in reality, she was taxed because it's included in her W-2. So what we have to remember here, the very important piece to this is, you have to get what we call and what they call a supplemental schedule from the brokerage where your stock is being held, because the supplemental schedule is going to have the value of what those shares were at the vest date, which is essentially your cost basis, because that's what you're being hit with and taxed on. So what this led to is this client got a letter from the IRS saying, hey, looks like you got all this stock and it didn't cost you any money. You owe tax on it. And that bill specifically was about 80 to 90 grand, right shy of 90 grand. And so what do we have to do? We have to go back and communicate to the IRS and say, hey, the letter that you sent me saying I got all this stock and it didn't cost me anything is incorrect. Here is the supplemental schedule to show you that this was RSU compensation and there truly was a cost at vest date. And here it's included in my W-2. So again, concentration, I think more of one issue where people need to start talking about how to strategically diversify their wealth. And then on the other side, it can be very tricky to perform your own or do your own taxes if you don't understand what schedules to input into the software. And that's where you can lead with, you're going to get taxed on money that you've already been taxed on once. So we need to be very cautious of making sure that we have the right forms when we go to do our taxes.
Understood. And this is great stuff. Here is where it gets useful. Because once you understand why the gap exists, the next question is obvious. Is there any real way to reduce tax on RSU income, or am I just stuck because it's W-2?
So great question here. And this is where you and I obviously have come to find out, and how we met is we have one shared thing in common, which is the STR side of things. It is a strategy as a tax professional. We have a whole toolkit of things people can do. This is a strategy that higher income earners that need a, we'll call it high ROI on an investment for a tax reduction. And that is the short-term rental strategy. Long story short, what my firm specializes in is how people utilize their rental real estate to offset their tax bill. And at a high level, this is what it looks like. Let's say that you have somebody being compensated at $1 million between RSUs and their W-2, just normal salary compensation. The goal would be if they went out and they bought luxury, lower end, whatever it may be, a rental property that can lose money on paper. We can get into that in a little bit, but let's just say that for tax purposes, we're going to lose money. So we buy a property, let's say at $800,000, and it loses me $150,000 on paper through depreciation, cost segregation, all that. Well, before the short-term rental strategy was really exposed, it was almost impossible for a RSU employee earner to utilize that rental property they just bought to offset their tax bill. I call it this like euphoric net effect. So before, what would happen is they would make $1 million, their property would lose 150. There's no way to net that out and only pay tax on 850, which is the ideal outcome. Now we understand how to do that if we have a short-term rental strategy where they execute all of the boxes, basically check all the boxes. And what that allows us to do now is you have a high income earner at $1 million. They bought an $800,000 property. It loses $150,000 on paper, which pause. That doesn't mean it's going to negatively cash flow. It's going to be a good cash flowing deal. But on paper, for tax purposes, we lose that money. And so now, if they check all the boxes, we are able to take somebody that earns $1 million, loses $150,000 on paper, and net those together to only pay tax on $850. And then usually I'll get asked the question, well, wait, could somebody do this with 2 properties or a larger property? And yes, we've seen people with $300,000 incomes completely offset their tax bill to zero. So when it comes to, hey, I'm a high income earner, I make a compensation, I make RSUs, right? I make a salary, I make RSUs. Is there any way to bring down my tax bill other than the traditional contribute to your 401k, do an IRA, things like that? Yes, there is. And it's through investing in real estate. And we've seen probably at least 100 clients at this point do this strategy. Because right now, like I said, it's one of the biggest ROI strategies you could do. And if you ask me, I'm a little bit biased as a real estate investor myself. Back to the topic of diversifying your wealth, it's a great way to diversify your wealth while at the same time get a major tax benefit for it.
Understood. So what I'm hearing from you, real estate losses are usually passive and cannot touch W-2 income. And short-term rentals, kind of create an exception, right? But let's talk about what actually changes that, because let's talk about proving it, right? Mm-hmm. How do you actually show the IRS?
And that is what I like to make the joke of is like most of the online advice doesn't discuss what it is you just mentioned with is the material participation. That is so important. And I'll say it flat out. If you don't focus on it, the strategy is not going to work. So prior to how I said normally that net effect would not work is because to utilize real estate losses against other income, you had to be what they call a real estate professional, which I can just tell you now, if you're a high level exec or earning RSUs at a business, you 99% of the time are not going to qualify as a real estate professional. The reason is there's 2 tests. You have to spend at least 750 hours in the business of real estate. So right there, that would be a bit of a challenge if you're a full-time employee. And the second test is what they're usually going to fail, which is real estate has to be more than 1/2 of your work time. Not going to happen unless you're going to try to say you work over 4,000 hours a year, which the court is not going to decide with you likely. So now that has blocked out us doing this strategy, we had to find other creative ways, which is the short-term rental. And again, we'll say for lack of a better term, loophole. The way that we are able to allow this net effect to happen now is because I like to say there's 2 roadblocks to being able to implement this strategy appropriately. Well, before you had to be a real estate professional to offset these, right? Like the income. Now, if you have a rental property where the average rental period is less than 7 days, you are now classified as more transient use property, and you're not held to the same rules for this net effect to happen, which is your non-passive income being offset by passive. So it's almost a way to now, hey, this isn't passive anymore because it runs more of as a business, is right, for lack of a better term, which is the first rule. Property has to be rented out for each stay on average less than 7 days. So, right, 2-night stay, 3-night stay, 1-night stay, 5-night stay, something like that. That is test number 1. Test number 2 is what you said, which is material participation. The IRS looks to real estate as being passive. If you can not only show that your rental property is being rented out on average for less than 7 days, and you can also prove that you are a material participant. You've rolled up your sleeves. You're not just an investor sitting back collecting a check. They will allow you to be or consider this a non-passive activity. Well, when it comes to material participation, how do I earn this status? For this, there are 7 tests. You only have to meet one of them. And all of them, you'll notice, have a common theme of saying, okay, this guy, Arda, is a true investor. He is working the property. He material to the operation. So of the 7 tests, we like to look at 3 because honestly, 4 of them are rarely hit. They have to do with activity in the prior year. So, right. So we'll focus on the 3 for now. Again, anybody here that watches this has more questions, glad to go into it later. Test number 1, we call like the golden rule, 500 hours. If you spend 500 hours in the business, that is a way to earn material participation and consider yourself a material participant. Most of the time with a short-term rental, you're not going to hit that. We see most clients hit test number 2, which is 100 hours, and that's more than anybody else. So if somebody else is on the deal and they did 120 and you didn't do at least 121, there's an argument to say, hey, this person did more than you. So you have to hit at least 100 hours and have it be more than anybody else. This is reasonable because 500 hours, unless it's a massive deal, you're not going to need to spend that much time. And in a normal deal, you can spend 100 hours through the acquisition, through the furnishing, through the getting it rent ready, dealing with tenants, listing it, things like that. And you can even still hire a cleaner here and there to come help you with the property. So that is the most common test. The third most common test is substantially all, meaning I've done all the work. No one else is involved. I bought it, I closed on it, I furnished it, I cleaned it, I listed it all myself. And so you can take that approach too. And if you earn this status of material participation and your rental average stay is less than 7 days, you can now unlock these losses to offset your W-2 income. So those are the qualifications and why it's so important to earn material participation status, because let's say your rental average is less than 7. If you are still passive in nature and just letting somebody manage the property, the IRS is not going to allow you to take that loss. So this is where some employees will kick back and say, well, I don't have the time. Well, maybe unless your spouse can do it, it's not a strategy for you. And this is where we show tough love to clients at times like, hey, suck it up. For the tax losses you are going to get, it is much worth your time to be able, hey, buy the deal in Q4, run it through Q4. But you have to find a way to spend the time in the first year to be able to get the tax loss to offset the W-2 income.
Okay. So let's say I work for NVIDIA, a very demanding job. I do not have time to materially participate managing a STR property. However, my wife has got a flexible schedule and seems like she can hit one of the material tests you explained. So she can materially participate managing the STR property and I do not need to get involved. Let's, kind of think about that scenario. Do I still qualify?
Yeah, no, that's perfect. So yes, and this is where we will see people where you typically have a high income earner, whether W-2, they could be running a business, whatever it may be, with a spouse that maybe does more of the homemaker stuff, taking care of the kids, keeping the home right ready, and then they can help manage that, which is nice because you now can both play a role in this as to having one side of high source income and the other side managing the property day to day, listing it, dealing with the tenants, and they will earn the status of material participation. Because notice the less than 7 days, that's just an attribute of the property, not the couple that owns it. The couple that owns it, someone in that household on that joint tax return is going to have to earn the status of material participation. And so it can be even better. So, right, if you have people that have one spouse has no job, and let's just say they are a real estate professional. Now your door opens up to doing long-term and short-term. But in the short term, you have to be able to earn that status of having material participation so that you can offset the W-2 income. And that's why I like to harp on it and say it so much, is because most Not most. A lot of people think that they can just have the less than 7 days or have an Airbnb and it's all good to go. When that's not the case, you have other things that you need to qualify for and check off.
So you already, like kind of answered this question, but just to be clear, because we get this question quite a bit, right? Especially from NVIDIA folks. Do I need a real estate license or to quit my job to use real estate losses against RSU income?
Such a good question. And no, you do not need a real estate license to do this. I think when people hear the term real estate professional, they truly think that, oh, what kind of designation do I have to have inside the real estate space to earn this? When even then, a real estate professional is just held to those two tests, which is 750 hours, more than 1/2 your work time in the business of real estate, where you run the business, you own the business. There's a carve out there that if you are an employee of a business, but you own at least 5% of it, that's tax for you. There's always little nuances there, but no, to execute on the long-term or short-term rental strategy, you do not need to have a realtor's license or anything like that. You don't need to be a realtor or have any sort of licensure. No.
Got it. So let's talk about our ideal, like kind of client, right? Because we've been working with these type of clients for a while now. They typically have $1 million plus concentrated in NVIDIA stock. Mm-hmm. So obviously the reason, like kind of they reached out to us because they are looking for ways to diversify without a massive tax hit. So, like given the fact that these folks have quite a bit, like kind of concentrated position, what would you, like kind of recommend them in terms of the size of the property, right?
But we take somebody who recently they make about $2 million and they went out to Sedona and bought a $3.5 million property. So typically you'll see the higher income earners, again, greater than $1 million, $2 million plus, they're going to buy a bigger deal because they simply have the financial means to do so. But this is where there's no right answer. I like to tell people in tax, this is what is your risk appetite? How good is the deal? If you truly think this is something that's going to almost help supplement your income for your family long-term because it is such a good deal, right? And it pencils well, then maybe it is worth to splurge a little bit more upfront to snag a good deal, as in anything in life. But it really is, what kind of deal do you want to get into and cash flow on? What's your capability for a down payment? What are you okay with parting with? Because we'll see, and I'm sure you've seen too, not only will people use some of their RSU income, they'll use savings to supplement the down payment and what they need to furnish it and get the deal up and running. So, it's just trying to stretch yourself, but get a deal that makes sense to where it's going to cash flow. It pencils as a good deal, and it's also going to help you save on your tax bill. But that's what we'll see. Earners greater than $1 million, their deal size probably going to be $1 million plus because they're going to get better tax benefit, and it's within their means to buy a deal that will cash flow more.